tax-free net worth method, underreported income. This is Ken Boyd, the owner of St. Louis Tax Preparation. Here's our Facebook page and our LinkedIn group, MBA Accounting and Finance. What this example is taken from is instructions in an IRS publication on how to computate when the IRS thinks that somebody has underreported taxable income. And the justification here is if your net worth has increased, and then we deduct off living expenses, deductions, and exemptions, we should be able to look at what's left over and call that taxable income. What this tries to do is to relate increase in net worth to income produced that's taxable. So let's walk through it. The student was given a question that says, all this data was provided. So we have years 03, 04, 05. Let's just look at 03 as our first example. We have beginning and ending net worth, which created an increase in net worth, positive number of 25,310. And the IRS publication says, well, let's deduct off three things. Let's deduct off living expenses that are reasonable during the year. And you can read the publication to find out what is meant by reasonable. Tax deductions, for example, itemized deductions and other deductions that a person would normally get, maybe deductions if you have a business, etc. And then exemptions, we're going to deduct off those three numbers. And the IRS publication says once we do that, we come up with a corrected taxable income. The previously reported taxable income is what the taxpayer reported, and so the IRS is saying, well, if we come up with this corrected taxable income and we look at what you reported, we think you, positive number, underreported by $342. Now I would ask you to ignore some of the computations on here because they were errors in the test bank for the question that was asked. I'm really more concerned about the calculations themselves. Now it's possible to have what we have in 2004 where the person's net worth was actually just a small increase, $2,300. When we deduct off the living expenses, the deductions, and the exemptions, we end up with a negative amount of taxable income. What this implies is the person had a small increase of net worth during the year, but when you deduct what they spent to live on, and then you deduct other allowances, it actually turns out to be a negative number. When we compare that what was previously reported, it was actually over-reported taxable income using the theory from the IRS. The typical test questions you get here are, what's the increase or decrease in the net worth, which we have here? What was the corrected taxable income once you went through this calculation? And finally, they'll ask you about the difference, giving the reported taxable income, what the person put on their tax return. What was the under or over-reported taxable income? That's the end of tax-free for net worth and underreported income. You can go to the Not on the Web section of our site to see additional videos and spreadsheets not on YouTube. Our YouTube channel, Ken Boyd STL. You can email me for a complete listing of our videos on YouTube. For live one-on-one tutoring and chat sessions, here's our website, our email, and our phone number. Thanks very much, and we'll see you next time.